This video will teach you about a type of investment fund called a business development company, or BDC, as well as an asset class called senior secured loans, which investors can access through BDCs. It is brought to you by Franklin Square Capital Partners, sponsor of alternative investment products designed for the investing public. Investors know the importance of spreading their investments across different assets. It's called diversification, and it limits the impact of a drop in value of one type of asset on the entire portfolio. Lots of portfolios have a combination of some or all of these popular asset classes. Keep in mind, diversification and asset allocation do not guarantee a profit, nor do they eliminate the risk of loss of principal. In general, most of the investments in a typical individual's portfolio are traded publicly and involve public companies. But there is a whole other side to investing that's missing from this picture: investments in the debt and the equity of private companies. Not so for large institutional investors and the ultra-wealthy. For a long time, they have been investing heavily in private investments for several good reasons. For starters, diversifying into private company investments rounds out an institutional portfolio. While diversification cannot guarantee better results, it spreads risks across a broader spectrum of assets. Also, private investments tend to have low correlation to these other asset classes. Correlation measures the influence the movement one asset has on another asset. Since investments in the private sector don't necessarily rise and fall with swings in the markets, having them in a portfolio can add stability. Finally, as these are private investments, there are fewer investors and much less competition, which can result in better terms and returns. It takes specialists to thoroughly analyze these transactions and large sums of money to invest in them. That's why only large investors like endowments, pension plans, and financial institutions could afford to enter this world. These factors have kept private investments out of reach for the investing public. There is a way for investors without multi-million-dollar accounts to enjoy many of the same benefits as institutions. A category of investment called a business development company, or BDC, enables you to invest in private debt and equity at reasonable investment minimums. Business development company may be a strange name for an investment vehicle, but Congress created the BDC in 1980 to allow individuals to invest in the private sector to help these companies develop their businesses. By law, BDCs must have at least 70% of their assets invested in U.S. private companies, as well as small public companies valued under $250 million. That ensures that money flows into these businesses to promote their long-term growth. Keep in mind, privately held companies do not publicly disclose financial information, so it takes specialized analysis to evaluate investments in these businesses. For the protection of investors, BDCs are highly regulated and transparent. They are not mutual funds, but are governed by the same law that regulates mutual funds. They are required to be SEC registered and are subject to exhaustive public reporting. They must have an independent board of directors and custodian, and must conduct quarterly asset valuations. BDCs, like mutual funds, pass through 90% of their earnings to investors, which allows them to avoid corporate taxation and provide investors 1099 tax reporting. Again, a BDC provides access to a variety of private debt and equity investments. Broadly speaking, within debt, there are secured and unsecured loans. We are going to drill down into an often overlooked asset class called senior secured loans. What is a senior secured loan? Senior means that these loans are the first in line to be paid ahead of other investment types. Being at the top of this stack can be critical should a company run into financial troubles. Secured means backed by collateral, much like a mortgage is backed by the house. If the company can't honor its loan, lenders can recoup their investment through the sale of company assets. That doesn't mean that these assets won't lose some or all of their value, or that there is no risk that an investor may lose principal. We're all familiar with loans, but senior secured loans are different from typical loans because they often have floating interest rates. That means the rate consists of a base rate, generally tied to a benchmark called LIBOR, plus a fixed spread. If interest rates increase, as may happen if we have inflation, the base rate on the loan will increase accordingly. Let's contrast what happens to investments that have fixed versus floating rates when interest rates rise. Those with fixed rates, such as government or corporate bonds, pay the same yield regardless of what's happening to interest rates. They lose value when rates climb because investors will flock to higher-yielding bonds. In contrast, the coupon payment on a floating rate investment, such as a senior secured loan, will grow. That lowers the risk of loss of value for investors. In this way, senior secured loans act as a hedge against increases in interest rates and inflation. That said, interest rate changes and other financial market risks could have a substantial impact on the performance of floating rate senior secured loans, as well as the value of any BDC that invests primarily in these loans. Another advantage of senior secured loans, especially those from private companies, is their low correlation with other major asset classes such as stocks and bonds. As mentioned, lower correlation can lower overall risk and add stability to one's portfolio. And again, diversifying your asset allocation pie with an asset focused on private companies provides a nice balance with publicly traded assets, reducing the exposure to the risks of any particular slice. If you are interested in diversifying your investment strategy with a non-traded BDC, be aware that not all are the same. First, make sure the BDC's investment objectives match your needs. Then examine who is running the fund. Start with the sponsor, that is, the firm that brings the BDC to market. Is private debt and equity their true focus or a side venture? Managing a non-traded BDC requires a deep legal and operational understanding of the complexities involved. An effective sponsor brings highly specialized expertise. Also, a sponsor who has its own money heavily invested in its fund should be more motivated to manage it in the investor's best interest. Equally important is the sub-advisor, that is, the asset manager who selects the right holdings for the fund. When it comes to investing in private debt and equity, look for a larger, more established sub-advisor with a strong reputation built on a solid track record. Size and scale give them the expertise and relationships to secure better investments for the BDC. Finally, consider the performance of the BDC. Funds designed to generate income, like those invested in private debt, should have a history of consistently competitive yields with demonstrated growth potential. And make sure that such returns are derived from real gains earned by the portfolio. Look for funds that seek not to use investors' money to pay out distributions. This policy should benefit investors. As with any investment, there are risks associated with BDCs, including those you see here, many of which we touched on earlier. An investment in a BDC involves a high degree of risk and is considered speculative. You should consult your financial advisor to see if investing in a BDC is right for you. The amount of any distributions we make is uncertain. Our distribution proceeds may exceed our earnings, particularly during the period before we have substantially invested the net proceeds from this offering. Our organizational documents permit us to pay distributions from any source, including offering proceeds, borrowings, or sales of assets. If we pay distributions from sources other than our cash flow from operations, fewer funds are available for investments and your overall return may be reduced. We hope this presentation has given you a better understanding of what a business development company is. Contact your financial advisor to learn more about your investment opportunities, and thank you for watching.